Dear friends, welcome to PMS Insights. At the outset, I would like to use this opportunity to wish you and your family a very happy Diwali and prosperous New Year. While October was a volatile month in terms of returns for both India and global markets due to spike in COVID cases and uncertainty around US presidential elections, markets have rallied sharply in the first half of November. Sentiments turned positive, marked by a few events: US elections resulting in a Democrat president but a Republican Senate, falling number of active COVID 19 cases in India, improving high frequency indicators, positive surprise in 2Q earnings, and success of COVID vaccine trials. As Joe Biden looks set to become the 46th president of the USA, risk assets are showing exuberance with MSCI World Index up 12% in the first half of November. The expectations in the market is that Democrat president and Republican Senate could be the best combination for growth, as election of Joe Biden could result in an easing of trade wars and ex-President Trump's tax cut and deregulation policies could stay in place. On the domestic front, declining COVID 19 cases in India, along with strong recovery in high frequency indicators like manufacturing PMI, power demand, GST collection, home loan, and auto sales, are adding to the optimism about the sustainability and pace of recovery. Q2 earnings for most companies were surprising on the upside, led by improved top line and margin surprise as India Inc. cut costs across the board. Most companies reported strong results, net profits being 12% ahead of expectations. This led to earnings upgrades for FY21 and 22 over the past month for Nifty 50 index. Based on our internal estimates, we are projecting a minus 5% and 29% earnings growth for Nifty in FY21 and 22. Commentary from banks NBFCs stood out, with most expecting restructuring to be in low single digits, collection efficiencies to sustain, and guiding for lower credit cost in FY22. While NPL formation will rise in H2, we believe banks are in the process of creating sufficient buffer, which is positive for the financial sector. At 20x FY22 earnings, Indian markets are trading at the higher end of historical range. However, given that there is a significant divergence in performance across sectors, few sectors like financials, retail, and mid and small caps could drive the next round of rally. Also, after 5 to 6 years of earning growth disappointment, we expect that there could be a cycle of earnings upgrades over the next 2 years, led by significant monetary easing, which could add strength to the markets. Coming to our portfolio positioning, we have balanced portfolios with focus on bottom up stock picking. Our focus is on companies which have good management, strong balance sheets, and have a long runway for growth. While we continue to have exposure to COVID resistant sectors like telecom, insurance, pharma, chemicals, and FMCG, we have incrementally increased exposures to sectors like auto and auto anchors, NBFCs, and banks, which could see strong growth over the next few years. We have also increased our exposure to quality mid and small cap names across our portfolios, which have become attractively priced after prolonged underperformance over the last 3 years. Thank you.